With the interest rate going up again this month, many clients who are looking to buy a home or have their mortgage renewing soon are wondering what kind of mortgage term they should get for their upcoming financing. So today we'll be going over how you can use a simple tool by yourself, whether it makes sense to go with a 3-year fixed option or a 5-year fixed option or any other options out there. So let's get right into it. First of all, you might be wondering, how long ahead of time should I be looking into this? Well, you should actually start looking 4 months ahead before your home purchase or renewal, because banks can do a rate hold for you up to 120 days. And this means that even if the interest rate goes up after your rate hold, the banks will still honor and give you the lower interest rate. This is very useful, especially in today's volatile interest rate environment, because there could be more rate hikes coming. Now, the two most popular options in today's market is the 3-year fix or the 5-year fixed rate. There are other options to consider as well, such as the variable rate or shorter terms, but these usually come with a higher interest rate compared to the 3-year and the 5-year fixed. And with rates already being so high and people expecting that it'll take some time before the interest rate drops again, most people are not really considering these options. That being said, there are some considerations in which variable rate or shorter terms might be more suitable for your situation. For example, if you're expecting a significant salary increase in the near future, or you're expecting a lump sum coming your way, then you might want to refinance your mortgage sooner compared to waiting out for the entire term. Or if you're looking to sell your place for any reason, you would need to consider the mortgage penalty for breaking out of the contract in the middle of the term. With a variable rate mortgage, the penalty is generally 3 months of interest. But if you have a fixed rate mortgage, then your penalty will likely be higher because it is calculated using something called the interest rate differential. Basically, the longer period you have left on your contract, the higher penalty it'll be. So depending on your timeline of selling or refinancing your home, you might want to consider a shorter term or even take a variable rate to be safe. Now, the tool we're going to use is the mortgage calculator, and the one that I'm using here is from TD. So you can easily Google this, or you can use any other mortgage calculator out there, and it should give you the similar results. So let's go to the mortgage calculator here by TD. And in this page, you're going to see that there's a couple items that you need to input. First of all, there's the mortgage principal, and then there's the interest, mortgage amortization, and payment frequency. So mortgage principal is the amount that we're intending to borrow from the bank. So for our example here, we're going to say we're borrowing $500,000 from the bank. And for the interest, we can either select a range of their posted rates here, but I can tell you that most of the time, the interest rates that are posted here are actually higher than what you would be getting if you were to do a pre-approval. For example, my own mortgage is renewing this month as well, and the rates that my bank is giving me for a 3-year fix is actually 5.41%. Right? So you can see it's the rate posted here is actually quite a bit higher. So what we can do is we can actually add our own rate into this calculator. And then afterwards, we can select the term. So in this first option here, I'm going to select 5-year closed. And the rate that the bank has given me is 5.16%. So amortization period, you can leave it at 25 years if you're a first-time home buyer. Or if you're renewing your mortgage, then you can put whatever amortization is left for your mortgage. So for me, I was at 20 years. And then for payment frequency, you can choose either weekly, bi-weekly, or monthly. And in our example here, we can just stick with monthly. And the other options to pay off faster or to add mortgage insurance, we're just going to say no to keep it simple. So then we click calculate my payments, and then we can see based on this rate for 5-year close, we're expecting $3,328 in monthly payments. And also what it's going to tell us is how much we're going to pay over the course of 5 years, how much interest we would have paid, how much principal we would have paid down, and then at the end, how much of a mortgage balance we would have left. So next, we want to add our 3-year term to compare. So in here, the mortgage amount would be the same, and then this, I would choose 3-year instead of 5, and the rate the bank has given me is 5.41. So the amortization period is going to be the same monthly as well, and we can see that at the end of the 3-year term, we're actually going to be left with a balance of $554,000. So obviously, this is not an apple-to-apple comparison, and if we wanted to do that, we would need to add another option to see what is the final result if we were to get a 3-year plus another 2-year afterwards. So we would need to make some adjustments on the last option here. So first of all, we would need to choose a 2-year option, and then the amortization period, we would also need to reflect that it's 3 years later. 20 minus 3 is 17 years, and also the mortgage amount is going to be different as well, because we would want to take the final balance after our 3-year term as the starting amount for our 2-year term. So we would copy this and paste it on top here. And then finally, what you want want to do is you would want to make a conservative guess of how much the interest rate would be if you were to renew your mortgage in 3 years. So here I'm going to say we're expecting maybe 4% of an interest rate 3 years down the road. And at the end, we can compare what is our mortgage remaining after 5 years in our second scenario if we were to choose a 3-year term. So we can see that our balance at the end of the term is actually slightly lower, which means that we would have paid off a little bit more of our mortgage. And if we dive into the numbers a little bit deeper, we can actually calculate what is the total amount of payment that I would have paid over 3 years and last 2 years. And these two numbers combined would come up to $195,000. So we can see right away that we've actually been paying less payments over the course of 5 years, but we're able to pay more of our mortgage off. And why? Is because we're actually paying less in interest. So we can add up the total of interest paid in the 3-year plus the 2-year. That would come out to $111,000. So that's about $6,000 less in interest that we would have paid if we were to pick the 5-year term. So from looking at these numbers, we can see right away that even though the 3-year mortgage rate is slightly higher, it still makes sense mathematically to pick the 3-year close if we're expecting the interest rate to be lower in 3 years. So this would definitely be the better option, and we'll be able to save you more interest and pay off your mortgage sooner. But before you make your final decision though, we should also calculate what is the interest rate required in 3 years for you to break even. And how we do that is by fiddling with the future interest rate here to arrive at a similar number at this balance at the end of term. So what I'm going to do here is I'm going to add 0.25% to this and see what is the mortgage balance going to be. So we can see it's slightly increased to 416. And what if we add another 0.25? So up to 4.5%. We're still slightly under the 418 that we're seeing from the 5-year term. So let's add another 0.25 to 4.75. And then we can see here it's actually very, very close to what we're getting at the 5-year term. And if we add another 0.25, it's going to be 5%. And we can see at 5%, we're actually going to owe more at the end of the 5 years. So what that means is the break-even point is going to be at 4.75%. Balance of at the end of the term is going to be similar. And if we add up the total of interest paid, it's going to come out with a similar number compared to the 5-year term. Payment is going to be similar as well. So what that means is if 3 years from now, the mortgage rates that you can get is not at least 4.75% or lower, then it would have been better off for you to pick the 5-year term instead from the start. And that's it on how you can figure out things by yourself using this simple tool. And as always, consult with your own financial advisor before making any financial decisions. Hope you found this video